Hello everyone, I hope last week brought you favorable trading results. How did your trades perform? I hope viewers of my channel are all reporting positive outcomes. If your results haven't been ideal, I'm confident that this video will completely transform your trading performance. In today's video, I'll share a model for confirming trend continuation. This model is exceptionally powerful. Today, I've decided to share it for free, because, after all, that's the very reason I created this channel. Let's get started. I'll begin with a bit of theory. When we observe a double bottom pattern, or similarly, a double top, when we identify this pattern, we typically expect the price to move in this direction next. Why is that? Because every technical analysis textbook teaches this. When you see a double top or double bottom, a head and shoulders pattern, or an inverse head and shoulders, these are signals indicating a potential trend reversal. However, when the price is at this point, here, it's not necessarily a signal of a trend reversal. This is merely an indication that the downtrend's momentum is slowing down. When the price fails to form a lower low compared to the previous low, it's simply a sign that the downward momentum has stalled. The first signal of an emerging uptrend is when the price moves up and forms a higher high compared to the previous high, higher than this high. That's the first confirmation. However, in many cases, the price then pulls back like this. If you look at a higher time frame, you'll notice that this entire price region is just a candlestick wick on a larger time frame candle. But on this time frame, we'd call it a false breakout. So, how do we avoid entering on a false breakout? We always wait for the price to return to a key level, for a retest to form a higher low compared to the previous low, with multiple candlestick wicks rejecting this price zone, accompanied by reversal candlestick patterns. This proves that the momentum of this pullback has ended. Only then do we enter a buy order. In this scenario, conversely, when the price reaches here and shows multiple rejection candlesticks, reversal candlestick patterns, demonstrating that this trend has exhausted, then we can immediately enter a sell order in this case. This is a clear signal that the downtrend is still continuing. Why is that? Let me explain. For a downtrend to end and transition into an uptrend, the first condition is that the price must form a higher high compared to the previous high. That's the first requirement. But when the price fails to meet this initial condition, failing to form a higher high, this confirms that the downtrend is still ongoing. Thus, we can immediately enter a sell order. The same applies to a double top pattern. Now, let's move to practical examples, because practice helps you understand the concept better. We can easily observe that the current trend is a clear downtrend, where the price has formed a lower high compared to the previous high. The price then retraced, attempting to break this high, but it failed. The evidence is the strong reversal pattern we see here. The price retraced again, trying to form a higher high, but it failed once more. This is a confirmation that the downtrend is still intact. Therefore, we immediately enter a sell order. In this case, we take profit at this low. The risk-reward ratio, RR, is 4.5 to 1. Let's see how the market plays out. This trade hit our take profit, TP. Now, let's move to the next example. We can easily see that the current trend is an uptrend. But this uptrend might just be a pullback within a stronger prior downtrend. Typically, we avoid trading pullbacks. However, there are exceptions where we can trade a pullback. What are they? First, we must confirm that this pullback is sufficiently extended. Second, we need to identify the continuation point of this pullback to enter the trade. And third, the trade we enter must achieve a favorable RR ratio as quickly as possible before the pullback ends. Let's analyze this. Here, we have a key level. Since this downtrend is strong, it doesn't form clear highs and lows. This is just a minor resistance key level. In this uptrend, the price has formed a low. This is the low of that uptrend. The price retraced to that low, rejected that low, forming a strong reversal pattern. In this case, the uptrend formed a low, retraced, tried to break that low but failed. Proving one thing: this uptrend is still continuing. Therefore, we immediately enter a buy order in this case. Stop loss, SL, is placed at the key level when the price returns to this key level, achieving an RR of 1 to 1. We manage this trade to ensure it becomes risk-free. It's slightly riskier, and we take profit at this high. The profit ratio is 3.37 to 1. Let's see how the market moves. The price hit the key level, so we move the SL to break even, the entry point. This creates a new key level, a new low here. The price broke the key level, suggesting this pullback might be over, leading to a new downtrend. But no, it was just a false breakout. The uptrend continues. This trade also hit our TP. This is an important example, a case where I entered a losing trade. Let me share it with you. We can see that the current trend is a downtrend. The price formed a key level right here. Multiple candlesticks rejected this price zone with two beautiful pin bars. This formed a reversal candlestick pattern, an engulfing pattern. Thus, I entered a sell order. In this scenario, SL was placed just above the key level. We take profit below this low, achieving an RR of 1 to 2. The price hit the target, but when the price retraced to this key level, a strong reversal candlestick pattern appeared, a powerful engulfing pattern, and I noticed this strong red candle. So, I entered another sell order. In this case, SL was placed above the key level, and I aimed for take profit at this low, setting an RR of 1 to 4. But immediately after, I got stopped out. Why? Let me explain. When the price moved down, it retraced above this level, forming an uptrend with clear highs and lows. Well, not entirely clear, because on a larger time frame, it's less obvious. It formed an uptrend with highs and lows. Many traders get confused here. No matter how strong the reversal candlestick pattern is, engulfing, evening star, morning star, it's not enough to reverse an entire trend. That's a key takeaway. When I saw this engulfing pattern, I entered the trade immediately without noticing the broader context. Let's zoom into a lower time frame for a clearer view. This is a low in an uptrend. The price retraced to this low and rejected it with a strong reversal candlestick pattern. On its way back, it didn't form clear highs and lows. unlike in this case. Here, the price formed clear highs and lows. But in this case, it didn't. It resembled a pullback, just retesting the level. Looking at this context, I could have entered a buy order. In this scenario, it was a great setup. We should have bought. But no. I sold instead of buying in this case. That's why I got stopped out. Right after I sold, I failed to notice that this green candle rejected the key level perfectly, supporting the continuation of the uptrend. I didn't recognize this, so I didn't cut my loss. If I had cut my loss in this case, I would have lost only about 0.3R, a very small loss. When we see we're wrong, we must cut immediately. Don't be stubborn. That's a lesson for everyone. Now, let's move to the final example. The current trend is an uptrend. The price retraced to this key level, rejected it with a bullish reversal candlestick pattern, an engulfing pattern. This red candle had a long wick. A beautiful setup, proving that the market respects this key level zone. The confirmation was this green candle, surging strongly upward, but for some reason, I didn't enter a buy order. In this case, my gut feeling at the time told me it didn't look right, so I chose not to buy. In the end, the market surged strongly upward, leaving me with some regret. But when the market plunged downward like this, I thought, oh no, the market is reversing. The trend will turn into a downtrend. But this green candle surged upward again strongly. I realized that this key level was still strong enough to hold the price, and the trend remained an uptrend. Although this pullback wave had strong momentum, evidenced by 3 strong red candles with long bodies, for me, this was still just a pullback. Why? Based on the previous example, the price didn't form a clear trend structure, with defined highs and lows. Thus, for me, I assessed this as a pullback to retest this key level. This green candle was the signal, allowing me to enter a buy order. In this case, SL was placed just below the candle's body. Take profit was set at this high. The RR ratio was 3.6 to 1. Let's see how the market played out. This trade also hit our TP. In summary, in financial markets, including crypto markets, you need knowledge to survive. However, when you have too much knowledge, it becomes your weakness. That's why in this entire video, I only shared one model. First, because it's powerful. Second, you only need to deeply understand what the market is telling you through this model. Practice it extensively, and I'm confident that this single model alone is enough to help you make significant profits from the market. Thank you for watching my video. See you in the next videos.